4 of the UnPACing Alpha podcast. It's Thursday, the 2nd of March 2023. I'm Sebastian Lander, Portfolio Manager at PAC Capital.
Hi, I'm Derek. I'm an investment analyst at PAC Capital.
And we're very lucky today to have Sylvia with us from Bullish.
Thank you. Thanks for having me, Seb.
It's our pleasure. So Sylvia, why don't we start off with a little bit about Bullish and what your role is there?
Yeah. So Bullish is a regulated crypto exchange, and we actually launched back in 2021. So just shy of a year and a half ago already. When we first launched the exchange, we kind of zoomed out and we thought, okay, what do we want to solve for? We knew, one, regulation was going to be a thing, and we knew, two, that institutions were going to come in to the space. And to preempt that, we thought, okay, what would institutions face in terms of largest roadblocks or barriers? And liquidity was a huge one. So we thought we would solve for liquidity and also be a regulated exchange. And I think that's when Bullish kind of designed this AMM model and central limit order model combined together to provide for that deeper liquidity that institutions would need.
Yeah, right. Okay, great. So, and what's your role specifically at Bullish?
So I'm the research lead at Bullish, and I produce institutional content for our clients. Other than the daily updates, I also do a podcast as well as conference reports, so different parts of the world with crypto conferences, so covering US, EU, APAC region.
Fantastic. We've got a lot of questions that we sort of want to get into today on the crypto space, but I guess you sort of touched on my first one already. So you target in that insto space, are you? And I guess what's the take up been like? Because from my understanding, and I'll say up front, I'm a bit of a crypto skeptic, but I guess my understanding was crypto was always more of a retail product, or retail investors were more interested in the space. So you're targeting insto. Are you seeing take up from instos now?
Yeah, so I think it's important to kind of divide the landscape and go, okay, back when crypto first started, it was very much meme culture, very much driven by retail investors. But since then, we've seen a lot of sophisticated institutions step in.
Right.
So there's market makers, there's some family offices, there's also some pension funds that have allocated into the space. And we're increasingly seeing this space grow with institutional clients. And that is also a reflection in the trading volumes that we've seen in our exchange. So since launching, just in the first year, we've seen over $150 billion in traded volume.
Wow.
Which is pretty phenomenal.
Definitely.
So you touched on earlier, automated market makers and centralized order books. Could you just touch on what's sort of the difference between those two, and what's the benefit of bringing those two together at Bullish as well?
Yeah, definitely. So AMM is short for an automated market maker model, and what that is that it's a constant product formula, which is X times Y equals to K. And to maintain that pool, for an example, if I have Bitcoin and USD in that pool, there's a 50-50 contribution of assets from both sides. If I'm trading against that pool, I don't need a traditional market maker to come in and meet the bid offers and they clip the spread. That's in a traditional central limit order book model. You're trading against the pool, so that rebalances according to whatever asset you're buying. So if I'm buying Bitcoin, I'm reducing the supply out of the Bitcoin pool, and within the other half, I'm increasing the USD supply.
Right. Okay.
So that formula always has to equal to K, which is that constant product market maker formula.
Right. Okay. And so Bullish have they've brought together those two models you were saying?
Yes. So we have an overlay of our AMM pools plus the central limit order book model, which is we also have market makers come in on the exchange and make markets, and that's overlaid to each other. So that's how we produce a deeper set of liquidity for our institutional clients.
Yeah. Right. Okay. Brilliant. And I guess with instos starting to step into the space, are you seeing any change, I guess, in maybe in the correlation of cryptocurrencies and traditional markets like equities and bonds?
So traditionally, we've seen quite a strong correlation between Bitcoin, Nasdaq 100, and S&P 500. So
Right.
throughout January, I believe it was 0.8 was a correlation figure of 0.78. It's oscillating between that. And actually, funny enough, in February, that's come down and it's become an inverse correlation,
Yeah,
so
right.
negative correlation, so negative 0.28, I think. And that's interesting because for quite a while, we've noticed that, particularly around macro events, so if the Reserve Bank, the Fed, was to announce a rate hike or CPI figures coming out, economic growth figures coming out, that generally moved in tandem with US equity markets and crypto markets.
Right.
So crypto markets, if we saw Nasdaq or S&P 500 climb, generally we'd see that reflected in crypto as well. That's kind of uncoupled a little bit in February, as I mentioned, with a correlation. And I think we've noticed that uncoupling, and the reason I think behind that is also because the crypto market's seen very thin liquidity at the moment, and
Okay.
liquidity thinning out in February, it's not hard to move markets.
Yeah.
In equity markets, you need billions and billions of dollars to move markets, but in crypto space, it's a much smaller industry. And if you were trying to liquidate shorts, and if you're a professional institutional trader and you're trying to hunt down these short liquidations, you can quite easily move the price and do that.
Yeah, right. Okay. So look, we're jumping around a little bit here, but I guess it kind of flows from what you said there. So more instos are stepping in, liquidity is getting better, it's getting deeper. But what role do you see crypto playing going forward then? I mean, if you are sort of seeing, I guess, adoption by more sophisticated investors, is that a sign that this, crypto as a space will become a more recognised and maybe a more valid asset class?
I think we're seeing a lot of institutions come into the space in terms of the tokenization aspect. So, for an example, there's green bonds that the Hong Kong government launched. That was on the back of Goldman's platform. I think it was called DAP, utilizing their infrastructure to launch these green tokenized bonds.
Yeah, right.
And I think that's quite an interesting kind of narrative, because when you look at cryptocurrency and then you look at the underlying blockchain technology, you think traditional space in TradFi, as we call it, you'd have a lot of portfolio managers, as yourself, that might be skeptical about.
It's too old for crypto. Let's be
yeah,
honest.
the cryptocurrency side, right? And then there's also the underlying technology of it, and we're seeing a lot of institutions come in to actually utilize that blockchain technology.
Okay. Brilliant.
And do you have a sense for the, kind of market participants that are still really active in the crypto space at the moment? For example, like between, retail, crypto native funds, traditional institutions?
Yep, so ever since FTX happened last November, we've actually noted a few market makers coming off, and that kind of incident has shaken the industry as a whole. It's taken some time for confidence to rebound and come back in. So thankfully, we're starting to see them come back and be more, I guess, willing to trade and willing to make markets within the space. Family offices as well. I know there was one here in Australia that we were speaking to that was quite risk adverse, as they normally are. They were in the crypto space and they got burnt by FTX, and since then they were going to completely, their CIO said that he was going to completely pull out of crypto investments and shut down the crypto arm. But thankfully, I've just spoken to them recently, and they've said that they're going to resume their crypto operations as well. So I think that confidence is just starting to rebuild and come back into the industry.
Yeah, right. So I mean, maybe we can just touch on, I guess, that sort of space and the sort of, I guess, the problems that some exchanges have had. So if you invest in a PAC Capital fund, your assets go to an administrator who keeps them very segregated from what PAC Capital do. Yes, we manage the assets. We don't have access to those assets. So maybe you can talk about, I guess, some of the problems that the crypto's seen with that segregation or non-segregation of assets.
Yeah. So I think to highlight what happened with FTX was the commingling of funds, and that was transferring FTX customer deposits into Alameda and supporting that side of the business. With our exchange, I can say that we have a custodian, and we also have Biget that have segregate our assets. So we don't use customer funds, and we don't commingle them either. I think we're going to start seeing the custody space growing a lot more within the area, because a lot of that confidence within centralized exchanges was broken since the end of last year. And so many customers are now thinking, okay, it might be a reputable exchange, but are my assets safe?
Yeah.
And there's a very common phrase in crypto: "Not your keys, not your wallet."
Yeah, I've heard that one.
Yeah. So I think it's also important to highlight as well that yes, you're using a crypto exchange to buy, sell, trade cryptocurrencies, but at the same time, if you're holding assets, it's also kind of more so of an educational perspective for clients to understand how to custody their own assets to make sure it's safe. Yeah.
Again, we are sort of jumping around a little bit here, but back in last year, in 2022, we saw some other, I guess, calamities in the crypto space related to so-called stable coins. We can dwell, I guess, on some of those if you like, but I guess where are you seeing the future for stable coins, and what models of stable coin are, or in your opinion, will sort of stand the test of time?
Yeah, so I think stablecoins is an interesting one. I think what you're referring to was the Terra collapse that happened in May last year. That was a huge systemic shock to the crypto industry, and there were huge repercussions that came off the back of that. That was what we call an algorithmic stablecoin. So they had a dual token model where there was UST, which is Terra, and then they had Luna as well. So what happens is if the peg broke, then an investor or market maker would come in and go, okay, I'll buy 0.98 UST and then take that into the Terra wallet and swap that for Luna, and then from Luna I would sell that onto another exchange, for an example, and then they would burn Luna and then either supply UST or mint Luna and then burn UST to fix that peg and make sure it's back aligned. So when Luna started, there was massive volatility in Luna, and when that depeg happened and Luna's price action just kept plummeting to the extent where it went down to like 0.000 whatever cents.
Yeah, wow.
That becomes an issue, right? And then that the peg just fell way below to any means of repegging that to a one-to-one basis.
Right.
So that's algorithmic stablecoins. I think there's definitely flaws to that, which is also why over-collateralized or collateralized stablecoins have been gaining market share. So, if we're looking at USDC, USDT, so USDT I think has $75 billion market share.
Yeah, wow.
Behind is USDC, which is about 40 billion in terms of the supply that's out in the market at the moment. So these are sizable stable coins, and when you start thinking, okay, what assets are backing those stable coins, you look under the hood and you go, okay, these stable coins aren't backed with just cash and cash equivalents. They're also backed with once upon a time actually commercial paper. USDT, I think it was back in 21 they had about 60% in commercial paper. That they've significantly reduced that to, I think, 0 as of late. So majority of these assets are kind of in US Treasuries. If you're clipping 5% yield, that's not too bad, right? And that's quite a profitable business model for them, without having to pass on any of those returns onto the customer, because that would defeat the Howey test, and that would kind of classify them as securities. So with that one-to-one stablecoin PAC, they're able to maintain that, and also underlying assets that they're exposed to is traditional market instruments, so money markets and US Treasuries, for example, short-term bonds. And that narrative was growing until the SEC came down a few weeks ago, and they issued a letter to Paxos about the BUSD that was linked to the Binance coin. And that caused ripple effects throughout the industry, where people were kind of a little bit risk off. They were weary about whether or not stablecoins would be classified as a security, and then have the SEC come down on that. So you saw very US-centric companies, or stablecoins rather, kind of lose market share and see some repercussions off the back of that. So USDC Circle is based out of the US. Coinbase as well, it's another exchange that's out of the US. They saw some effects, and to highlight, I guess, the difference of USDT and USDC, there's a geography analysis where you can see USDT being used in a lot of the Asian region.
Yeah, right.
And then USDC being used across EU, maybe UK, and primarily America. So the market share was kind of shifting into USDT, and that's the Asian region. To give it a little bit more context, Circle, US company, USDT backed by Bitfinex, which is an exchange out of Hong Kong, so Asia. So you've got that east-west kind of dynamic going on.
Yeah, right. Okay, interesting.
So do you feel that all these systemic events that have been happening in the crypto space, are these events sort of helping to make the crypto space grow more stronger and robust over time?
Yeah, I think definitely. With systemic shocks, it washes out fluff, right? And we've seen that in not just crypto, we've seen that in traditional markets as well. So GFC, when that happened, the Bernie Madoff scandal came out, and that kind of got washed out. These systemic shocks are part of the economic business cycle, and when you go through them, you learn what you did wrong, and you kind of build the safe rails to make sure that the past mistakes aren't made again. And crypto is a very nascent industry. I think what we forget is, it's a decade, just a little bit over a decade old, and for the industry to grow, it needs to fail as well. And to fail, it will start to learn the processes of, similar to traditional markets, what we learnt there, it's correlated, and we're learning and we're building, and we're also fixing the infrastructure to make sure that there's a stronger foundation for what we want to build in the future.
Right. And just on crypto applications as well, there's been quite a lot of hacks that have sort of happened amongst various crypto applications, say within like DeFi, for example. Whether due to problems with bridging or smart contract vulnerabilities. How would you say developers are trying to sort of address these sort of issues?
When we're looking at DeFi hacks, I think Chainalysis does a really good job in providing this graph. It shows you the hacks on an annual basis and what makes up those hacks. So whether or not it's centralized services or DeFi or DDoS attacks, so cyber attacks, for an example. And you see this huge transition. So 2016, a lot of it was centralized services, 2017, 18, 19, and then 19 hit. And in DeFi summer of 2020, the DeFi hacks started growing immensely, and that started eating up a lot of the hacks to, I believe 2022 was like $3.8 billion in hacks. And you see that kind of progression in that graph and you go, okay, wow, so what happened? Why did DeFi start getting hacked, and why is centralized services kind of coming down in terms of that total market share of hacks? And you realize, okay, centralized exchanges learned from their mistakes of getting cybersecurity hacks, and they've reinforced the safe rails for that. Whereas DeFi summer just started in 2020, and it just exploded. So, you know, you've got so many different protocols that came out with borrow and lending platforms. And so the smart contract vulnerabilities within there was, of course, there's always going to be flaws when you're looking at this. And for hackers it's a no-brainer for them to kind of come in and be like, okay, there's so much money coming into this space. The TVL at one time, it was I think $180 billion. So that's quite a large incentive if you're a hacker to come in and be like, okay, I want to take some of that pie.
Yeah.
Specifically, I think Lazarus Group, which is a North Korean hacker group, they last month there was a Harmony Bridge attack, and I think they took quite a 100 mil or so from there. So these kind of hacks are persistent within certain groups as well.
So with these hacks sort of, I guess, taking place in the crypto sphere where you know, money moves around the blockchain and you don't have that backstop of, you know, your bank, your CBA or your NAB to sort of help you recover funds. I mean, I think I read recently that someone did step in and did help get some money back. Do you want to just maybe talk us through what happened there, and then I guess your view on that, and whether or not we should have some centralised body stepping in to help people recover funds?
Yeah, so I think what you were referring to was Jump and their recovery of the wormhole attack.
Yes, that was it, yeah.
So it was about $300 million that was hacked, and they did a Oasis and Jump kind of partnered together, and then they did a reverse contract hack to recover some of the funds. There was a Bloomberg article that came out about that, and it kind of highlighted multi-sig wallets.
Yeah, that's what I saw, yeah.
So I think multi-sig wallets, one of the main, I guess, pros of a multi-sig wallet is that it eliminates doesn't eliminate, but it kind of reduces key person risk. So what we saw in Quadriga CX, it was a really big exchange where it's quite controversial because there's a Netflix documentary about
the
this.
Canadian one,
the
right?
guy that
He
kind of
went to India and died, or did he die?
Fake his death.
Yeah, I was going to say
There's
that.
a huge conspiracy around that. And the reason why I highlight that is because he was the only one that held the keys to the exchange.
Right.
So that was key person risk.
Yeah.
And what multi-sig does is it kind of caters for that. And you go, okay, there's 5 signatures that are linked to the wallet, and you only need 3, for an example, to sign off on a transaction. So that means that no one person can move or funnel funds without the other 2 approving if it's a 3 out of 5 multi-sig. So that I think it makes sense for things like centralized exchanges as well. Yeah.
Okay. And so, I guess, you know, so I think I've read that sort of, I guess, some of the sort of hardcore traditional, I guess, crypto and blockchain sort of believers, they don't want any centralized involvement in a way, sort of anybody that has control or can exert any authority over the blockchain. It should all be, you know, confirmed by sort of, I guess, miners or sort of other means. What's your view personally? Do you sort of feel like you do need people in that space helping to, I guess, regulate it or control it, or, you know?
Yeah. I think it's interesting because if you look at a lot of the coins out there, and Gary Gensler, I think last week, a few days ago, came out to say everything other than Bitcoin is a security.
Yeah, right.
And
that's
it's
the
interesting.
SEC chair.
Yeah,
right?
the SEC chair. Yeah, he said that. And he said that because Bitcoin's unique history and the way that it kind of came about is different from other altcoins, which I kind of think, okay, it makes sense in certain ways, because his argument is that if you look at other coins and other projects, you've got some sort of centralized body behind it still, which you might have a legal counsel that's advising which jurisdictions to operate in for that protocol, or which licenses to apply for first, for an example. And I kind of agree in that sense of his argument that he says that a lot of these other projects do have some kind of centralized body. And even when you're looking at Ethereum, for an example, that's a decentralized platform. But if you look at the stakers and the node operators behind, it's Lido, that's number one. I think they have about 25% market share. And then number two is Coinbase. And then number three is Kraken. And other than Lido, the other two are centralized exchanges. So if you see it from that perspective, I think ultimately, if you ask for my opinion, what is the most decentralized cryptocurrency? I think Bitcoin still stands as one of the most decentralized ones. You don't have a spokesperson, Satoshi Nakamoto, who created it. We don't even know who he is. And you've got many people claiming that they are Satoshi, but from my knowledge, he's kind of disappeared. And there's a network of core Bitcoin developers that are maintaining, or are the janitors of the platform, but it's not to say that there's a legal advisors telling them, okay, avoid the US because the SEC is going to come after you.
Yeah, right. We are jumping around again, but I did actually want to touch on Bitcoin at some point. I mean, you hear a lot of, I guess, conspiracy theories about who actually invented Bitcoin and the whole blockchain. Do you have a personal opinion on what could have happened there?
It's very hard to say. I think there was probably one person that did create it and start it.
Right.
And there's this conspiracy theory that the US government started it,
I've heard that one.
I've heard that one.
Yeah, but if you kind of think about it, you go, okay, if the US government really did start it, then won't they want to kind of support Bitcoin and then say it's cement themselves as a global reserve currency, because dollar dominance is also kind of in question. That's another rabbit hole, but I think at the same time, if you say the government created Bitcoin, really, because Bitcoin is fundamentally, if you think about who buys into Bitcoin, it's people that aren't trusting of the government, for one, and they want a kind of, not so much inflation hedge, I don't like to use that word because there's so many counter arguments as it being digital gold and whether or not it's actually an inflation hedge. But I think of it as a completely different asset class that you can hold and store wealth, basically. Do you want to return from it? Okay, maybe, but it essentially, don't take my word for it, but if you look at other countries, developing nations, for an example, in Venezuela, Turkey, Ukraine, Russia, when things go bad in your government, where do people turn to? And all these places that I've noted had Bitcoin premiums at a point. And that means that there's been significant demand for it. And why is that? Because they don't trust their domestic currency.
Okay.
When you're running from warfare, and we're quite privileged in Australia. We have passports and bank accounts that have borders that keep us operating in a very sophisticated financial infrastructure. But don't forget, there's also the other side. There's developing nations. People don't have access to bank accounts. People don't have access to identity cards that are linked to their financial systems. So these people are running and they're trying to cross borders, and sure, they can hold gold bars and then have pirates steal them, which is a true story, because that happened when I'm half Vietnamese. So my mum, when she fled Vietnam, they actually had to hold physical gold bars to cross on the boat, and pirates actually intercepted them and stole those gold bars.
Wow.
But if you think back to these kind of situations where these developing nations and people that are on the run and trying to escape their dire situation, you go, okay, in my mum's scenario and in my grandfather's case, he could have just kind of converted that into Bitcoin, for an example, and written down a 20-word seed phrase, given it to each child and been like, okay, just remember these 3 words, and then have that divided by 24 words, and then off they go, and no pirate could ever intercept that.
Interesting. Maybe we can talk now, I guess, about the future for, I guess, some of the more nascent parts of crypto. So, well, it's all I guess, a nascent technology, but certainly in the past couple of years, it seems to have had a number of, I guess, underlying use cases emerge. Things like DeFi. I mean, what do you see as the big sort of, I guess, developments in DeFi, for example, and maybe some of the other spaces?
Yeah, so I think DeFi specifically, I did mention tokenization of assets was a huge one. So the Hong Kong government did one, and I think there was another firm like JP Morgan. They also came out and partnered with another firm to do tokenization of bonds. This is a increasing trend because it increases the efficiency in the bond market. So you're kind of eliminating these intermediaries, these clearinghouses, and it's a lot more lower cost and much more accessible to people. So infrastructure like that within DeFi, I think, is a narrative.
Brilliant.
Okay. What about NFTs? That's been a pretty exciting area. Could you touch on some of the latest developments you see sort of in that space?
Yeah, so quite recently actually, ordinal NFTs, I don't know if you've heard of that, but that's become a thing. So ordinal NFTs are NFTs on the Bitcoin network rather than the Ethereum platform or Solana platform.
So I thought Bitcoin couldn't handle NFTs.
Yes, great question. Okay, so in November 2021, we had a taproot upgrade, which meant that the byte size limit for Bitcoin went from 1 megabyte to, they expanded it. I think the maximum that it ever processed was 3.98 megabytes. So suddenly this update allowed Bitcoin to attach, the sats, which is the satoshis under Bitcoin, so you can kind of fragment it into like up to 8 decimal places. They could attach JPEGs, they could attach media, they could attach text, and NFTs could be a thing on Bitcoin network.
Yeah, right, okay.
But that kind of never picked up. So that narrative, I was watching it back in November 2021, and I was like, this is interesting because it means that Bitcoin network can suddenly process smart contracts as well.
Right.
And that kind of never was a thing because when it was first invented, it was limited to 1 megabyte. And ordinal NFTs started becoming a thing. So if you have a look at the inscriptions, I think there's over 200,000 now, and that kind of started back in January this year, late January, early February, I'm going to say, this year. And that's kind of occupied a lot of the Bitcoin network, and in NFT spaces, that's a trend that's kind of happened. And Yuga Labs also came out to say that they're going to launch a collection of 100 NFTs, I believe, ordinal NFTs on the Bitcoin network.
So I guess for someone like me who's just not down with the kids and doesn't really get NFTs, right? So I see these pictures of these Bored Ape NFTs, right? And people are paying exorbitant amounts of money for them. Yeah. And I sort of think, well, I could look at it on my phone, screenshot it, and then I've got a copy of that image on my phone that I own now, right? Yeah. Where's the value in NFTs? Just explain it to somebody who's just too old to get it, because I just don't get it.
So I think, okay, it's kind of hard to understand because if I went back 20 years and I said there's going to be something called Instagram and there's going to be an ability for you to buy likes, you as a portfolio manager would be like, why would I ever invest in something like this? Buy likes. They're just invisible like digits, right? Yeah. It's like 3,000 likes, 5,000 likes. Why does that even matter? And fast forward to 2023, marketing has been a huge influence with Instagram and advertising. So these revenue business models start popping up and you start to see the value of these likes suddenly. And as a portfolio manager, you might start allocating into Meta they exceed expectations for their revenue of Q4, which they haven't. But yeah, so what I'm getting at is it's very hard to understand from that perspective of why. And NFTs is a cultural movement, I think. And at the same time, it's also community. So if you look at these clubs of Bored Ape Yacht Clubs, which is your monkey picture, these people identify with these JPEGs. They kind of embody the JPEG itself, and they get access to 100, 150 other people within that group chat and that community. And they meet up, they talk about different things in the ecosystem that's going on. It gives you a sense of belonging.
Right.
And coming down to humans as human nature, we're social animals, and we want to be liked. We want to be in a community. We want to feel like we belong, and that kind of adds to that aspect. And then when you go on to the monetary side and the revenue side of things, you go, okay, what can I actually get? Well, Yuga Labs does a good job in terms of incentivizing their NFT holders. So, for an example, there's been a case where a friend of mine actually owns a Bored Ape, and he rented it out to a drink company called Liquid Death.
Really?
And these IP rights, you'd be surprised, people pay good money for them.
So he rents it, and then these guys can display it at their event.
Yeah, they display it on their water bottle. Yeah, so there's
on their water bottle.
Yeah,
right. And pay him to do that because he owns that image.
Because he owns that IP. It's about that IP and that marketability of that image, so to say. So you can snap it and you can say, oh, I've got a Bored Ape too, but will Liquid Death, will Nike, will Adidas really pay you money for that if you don't really own it? It's questionable, right?
Yeah. I guess the skeptic in me is like, if they had just taken that image and put it on those water bottles at their event, how would your friend have known about it?
It's IP rights at the end of the day, yeah. And Liquid Death and Nike, Adidas, Starbucks, they're companies with money, and they can pay you for your monkey picture at the end of the day.
Yeah,
that's
true.
That's what they want to do. And in expanding that, I think there's definite ways for businesses to gauge. So, for an example, if I own an Adidas NFT and it's on the public chain, and then I go and buy a Yuga Labs, a Bored Ape Yacht Club ape, then you can kind of derive a character profile around that consumer.
Right.
And you go, okay, so this might be a male if he's buying male sneakers and as NFTs, for an example. And okay, if I'm a new entrant and I'm trying to sell you, okay, maybe some gym gear, and I note your profile as a consumer, as someone that is my target market, I can just airdrop you something and go, hey, I'm going to airdrop you a 20% off like gateway NFT to my new collection. And I know that statistically you might be more likely to be a customer of mine than someone that drinks Starbucks coffees and buys NFT from their loyalty cards. Right? So there's a marketable aspect to that too.
Yeah, brilliant.
Do you still see sort of a lot of manipulation that sort of happens in the NFT space? For example, wash trading?
Yes, so wash trading is an interesting one. I think that, I don't know if you remember, but there was a period of time where LooksRare, which is an NFT marketplace, had all these headlines. They overtook all these media headlines going, NFT marketplace, LooksRare overtakes OpenSea by 2x volume. And you go, okay, really? Wow, that's very impressive for an NFT marketplace that just launched within 48 hours. How did that overtake the world's #1 NFT marketplace? Right. And you go, okay, let's look at the trades. And you start to see these wash trades going on, and you go, okay, why are people doing that though? And when you look at the incentivization model that LooksRare uses, it kind of incentivizes traders to fake these wash trades, to mint these rare tokens, looks tokens, sorry. And when you actually look at June Analytics has a platform that you can see where these wash trades are coming, what the percentage of these wash trades are, and most of the time, I think it was 98% of LooksRare's trading volume is actually not organic, meaning they're wash trades.
98%.
Wow.
Yes,
Wow.
huge percent. And yet they're still number 2 in terms of the world's largest trading volume for NFT marketplaces. OpenSea is number 1. OpenSea's wash trading is less than 2% the last time I checked.
Wow,
So
okay.
mostly organic trades. So that's, I think that says a lot.
Yeah, I think that's been really, really interesting, sort of hearing you touch on all these different areas. You know, there's obviously quite a lot happening in crypto, and I can imagine it being quite tough staying on top of all of it.
Yeah, it's a huge space, and it's like saying in buy side when you're trying to cover one sector, the consumer staples, consumer discretionary, and now suddenly crypto's grown to all these different sectors like DeFi, ecosystems, smart contract platforms, and you're trying to cover everything, which is almost impossible, but yeah, we'll get there.
Brilliant. Well, that was really informative. Thank you very much.
Thank you so much for having me.